Okay. So we just understood the theoretical aspects. Now we will go into the problem on compound financial instruments, and keep it in mind from exam point of view. This is one of the most repeatedly asked area. There is one area in other standard, India's 109, it's something called a staff loan. That is one repeated question. And here this debt equity portion, compound finance instrument, is one more frequently asked question. Let's understand about this problem now. Mega Limited issued. I hope you got the question. Please make sure you come to this question. In this problem, we will try to understand about all the varieties, all the adjustments that are possible uh, in this problem, and then of course we'll do many more for practice purpose. My voice is clear, right? Voice is clear, PPT is visible, everything is fine. Yes, okay, very good. So let us move further. Let's read this. Mega Limited issued rupees 1 crore worth of 8% debentures of the face value 100 each at par value basis on 1st January 2011. These debentures are redeemable at par at the end of 2014 or exchangeable for ordinary shares of Mega Limited on 1:1 basis. What is 1:1 basis? For every one debentures, you get one shares. 1:1 basis. So face value of 100 each, you have debentures, and one debenture you'll be getting one debenture, one share. The interest for similar debenture that do not carry conversion entitlement is 12%. You're required to calculate the value of debt portion of the above compound financial instrument, and face value of equity share is rupees 10. Face value of equity share rupees 10 is given, right? Uh, have they mentioned face value of equity share rupees 10? Okay, you can just mention that. You can just add it to the question. Assume face value of equity share is rupees 10. Okay. First, why this is called as compound financial instrument? You know basic meaning of a debt where entity has obligation to pay cash, and basic meaning of equity where you will have fixed for fixed test, fixed number of shares and fixed issue price. Now in this case, it is convertible debentures, right? So at the end of the maturity period, if the holder wants, the amount may be paid in cash, or if the holder wants to convert into share, then redemption will happen by way of conversion into shares. So if the holder says, I want cash, the entity will have an obligation to pay cash. So it will fall into the category of debt. And if the holder wants shares, then 1:1 fixed number of shares and amount of consideration already received. So conversion price also also known, issue price also known, number of shares also known. So if the holder wants, the shares will be issued at a predetermined rate and number of shares. It will fall into the category of equity. So we are having a situation where it will fall into the category of debt as well as equity. It has both the characteristics, and that's why it is called as compound financial instrument. And in that case, what the standards suggest, the accounting treatment, split accounting, they say you eliminate, you separate into debt component and equity component. And how would you do the debt component and equity component? The standard says like this. Okay, so let me tell you the process, and then let's also write down the logic. This is the first problem, initial problem. We'll understand in detail. First, we'll focus on what is required for exam, and then we'll focus on overall concept in detail. Okay, so what the standard says. So compound financial instruments. Debt. So what they say is this: you have total proceeds from the issue of instruments. Okay, so total proceeds from the issue of instruments, that amount we write, less the debt component, then remaining amount will be the equity component. Isn't that the definition of equity? What is definition of equity? Residual interest. Asset minus liability. The proceeds represents the asset, money received from issue of debenture, issue of whatever instrument, minus the debt component becomes the equity component, residual interest, balancing figure like a net assets, asset minus liability. Now, debt component, how the standard says, how debt component is calculated. You calculate present value of cash flows discounted using non convertible bonds rates. So how are we going to split the accounting? Is using this method. So we will write the total proceeds. From the total proceeds, we subtract the debt components, and the remaining component what we get is equity component. And how do we calculate the debt component? Present value of cash flows discounted using non-convertible bonds rate. Because this we having the convertible bonds rate, but you discount it using non-convertible bond coupon rates. Non-convertible bond coupon rates. What is the logic behind that, sir? Okay, so calculation format only this much. Total proceeds minus debt gives you equity. That's all they ask in exam. But what is the logic behind this? We'll understand once more. Hope you would have aware of it by now, but I'll explain once more. Look at the debenture. You are having 8% convertible debentures, right? 8% interest. But if the same debentures, a similar instrument, everything is same except the conversion option is not there, then it would be 12%. Are you understanding? The difference is due to the difference in coupon. Sir, why is that difference in coupon is applicable? Because of conversion option. Sir, connect it a little bit better, sir. No problem. If you want conversion option, you will get only 8%. If you don't want conversion option, don't worry, you will get 12%. So, because you wanted conversion option, you are giving up 4% interest in a way. In a way, yes. 4% is the interest given up by the company for giving them the holder the option to convert. So from the entity point of view, they are giving one option, they are giving one choice, and holders are getting that benefit. So holders are receiving the benefit of conversion and they are sacrificing the interest. If you think from holder point of view, I'm sacrificing my interest coupon and I'm getting the benefit of conversion. From the holder, from the company point of view, issuer point of view, you are giving them the benefit and you are getting one benefit. What benefit you're giving? The ability to convert. What benefit you're getting? The savings in interest. The standard says you are getting one interest and you're getting one cost, don't show them, don't set it off, show them, show both of them. How to show them, sir? When we calculate, we'll get more clarity. Okay. Then how do you calculate debt instrument, sir? What is the logic behind this? Okay. Now, if this instrument was a pure debt instrument, if this was a pure debt instrument, what is the meaning of pure debt instrument? Entity has obligation to pay cash. Entity has obligation to pay cash. I'm only discussing the debt instrument portion. I'm not discussing conversion option here. I'm discussing situational. If this was only a debt instrument, so how much amount you would have been paid at the end of year one? Entity has an obligation to pay cash. How much? On 1 crore, 8%. That means you have to pay 8 lakhs. Correct? As coupon, obligation to pay cash, 8 lakh. Year 2, how much will you pay? Again 8 lakh. Year 3, how much you have an obligation to pay cash? If this was a debt instrument, again 8 lakh. Year 4, two payments will come. One is 8 lakh and other is redemption price, which is 1 crore, 100 lakhs. Now, again, I'm not thinking about the conversion option here. If this was without a conversion option, how much cash flow under this instrument you would have paid? Or 8 lakh, 8 lakh, 8 lakh, 8 lakh, 100 lakh. But see, these are all the returns you get, right? These are all the returns you get from an investor point of view. How much you would have paid you to get these returns? How much would have been the investment value today? What would be the value today? Okay, if you do not have a conversion option, will you expect 8% today? If you expect 8% today, the present value will come to 100 lakhs only. If you don't have conversion option, your expectation is not 8%, your expectation is 12% required rate of return. I don't have any other conversion option. I want 12% for my this thing. Therefore, I have to discount. Year 1 discount, year 2 discount, year 3 I'll discount, year 4 I'll discount. How much present value I get, that will be the amount would have been invested by a person if these were the cash flows without conversion option. Are you understanding? If I do cash flows of the convertible bonds but discounted using non-convertible bonds, why is this a mix and match, sir? Because from the convertible bonds I'm taking the cash flow, I'm taking the streams, because I have to value those cash flows, obligation to pay cash, so I'm considering those cash flows. And my discounting the value today, I'm not using 8%, because I'm looking at a situation. If this was a pure debt instrument, an investor would have paid how much? Investor would have paid for these cash flows, he wants 12% rate of return, so he would have invested at present value, discount using 12%. Are you getting it, sir? Why are we using 12% once more? That 12% is purely for debt instrument. What do you mean by that, sir? A person had given you loan. You had taken a loan and you told, I will be repaying 8 lakh, 8 lakh, 8 lakh, 8 lakh, and last year 100 lakhs. How much money will you give it to me? Investor says, I am requiring 12% rate of return. These are the cash flows you give me. I'll discount 12%. I'll give it to you. Thereby, I will get my 12% return. Hope you got the concept and logic behind this. In simple words, we wanted the market expectation from this instrument purely on a loan basis without conversion basis. So we took the coupon rate of a non-convertible bond that gave us the proxy rate, that gave us the expected rate of return for the investor if there was no conversion. Did you get the point? Okay, let me just quickly write that for you. It might be useful later. Every problem will not write, being an initial problem. Why do we use non-convertible bonds coupon rates for discounting? Okay, okay. To value the cash flows considering uh, uh, to value cash flows considering it as purely debt instruments, the required rate of return for the lender without having conversion option is required. Okay, such or non-convertible bonds coupon rates are used for such market return, that is return for investors without having conversion option, without having conversion option. So ultimately what is thing to be required? Cash flows will come from convertible bonds, discounting rate comes from non-convertible bonds. That is a one line you should remember for exam. We discuss so much concept, but one line answer is cash flows comes from convertible bonds and discounting rates from non-convertible bonds, non-convertible financial instrument. Okay, now let's calculate the amounts. I hope you have taken down till here. Any doubts on this one? Okay. Okay, let's go to now pure examination portion, calculation of it. Okay, so as on 1/1, as on date of issue, it is 1/1/2011, I think, right? Yeah, 1st January 2011. So what is the total proceeds from the compound financial instruments? Total proceeds from this instrument is 1 crore. Less debt component. Uh, Coupons, present value, because every year 8 lakh, 8 lakh, 8 lakh. So since every year is 8 lakh, you can simply multiply it by annuity factor. Present value of coupons. Eight lakh every year, because 1 crore into 8% multiplied by annuity factor. But while taking annuity factor, which one are you going to use? Discounting rate will be from the point of view of a person not having conversion option. That is non-convertible bonds coupon rate 12% for 4 years. 12% for 4 years. Okay. Plus the present value of redemption price. Redemption price is 1 crore because redeemable at par into discounting factor at the rate of 12% for fourth year. Fourth year. You can also prepare tabular format like what we used to do in SFM: year, cash flow, discounting factor, discount cash flow. You can also do like that, or ultimately. But hope you understand the concept ultimately. 8 lakh, 8 lakh, 8 lakh, 8 lakh last year, 100 lakhs, totally 108 lakhs, and all of them discounted. So today, 8 lakh discounted, second 8 lakh discounted, third 8 lakh discounted, last year 108 lakh discounted to today value, because these are all obligation to pay cash if this was a pure financial instrument. And because coupons is every year, to bring it to present value, we can make a use of annuity factor. A redemption price is one time, so I'm applying discounting factor. PVIF, I hope you know that. Institute sometimes use the word PVIF, present value interest factor. For 1 year, we use discounting factor. For many years where cash flow is same, we make use of annuity factor. Ultimately, both discounting factor and annuity factor will convert the future value into present value. Okay, so let's see how much it gets. 8 lakh to annuity factor is okay. So if I take 4 decimals, I think 3.6048 or 4 years, right? Not 4 years. 3.0373, right? Approximately you get 3.0373 Discounting factor, that is 1 crore, not 1 crore. And last year, 0.6355. 1 crore, 0.6355. That will give you 508414, right? Approximately. Eight lakh into 3.07, 24 lakh 29,840. Okay, I'm just taking one decimal more. You can take either ways. I'm taking 3.0774. I'm taking. You can round up both the ways. Yeah, 735. So you can round out to 4 also. I'm just rounding it up on the upper side. 734. So 29 lakh 29. 24 lakh 29, 920. 24 lakh 29, 920. Plus this one, 63 lakh 55,000. The total amounts 87, 84, 920. So you are receiving 1 crore, 100 lakhs. But if you were to give not the conversion option, if you did not give conversion option, then the person would have given only 87 lakh. So why are you receiving more? That receiving more is the benefit received by the company towards the conversion option. Equity components, balancing figure is 12 lakh 15,008. Some rounding off here and there can be different, but approximately this number you should get. So what would be the interpretation of 87? If the entity did not give conversion option, they would have received, because it's only worth so much, they would have received 87 lakh 84,920, but actually received 87, 84, 87 received 1 crore, received 1 crore. The excess given, excess received, the excess received, excess 12 lakh 15,080, excess receipts represents or attributable to the benefits provided by the issuer. It's like consideration for benefit given to the holder. So when the holder gets some benefit, he will give benefit. So entity is giving some benefit, like a call option writer. Actually, if you know the call option position, you'll be able to understand better. Because what will happen in the call option? The holder gets the right. Does the right comes free of cost? No, he has to pay premium. So the holder gets the right, the writer gets the premium. In this case, the holder is getting the benefit of conversion, and not the benefit directly, but in the form of the losing the interest, he paying the premium. Are you understanding the point? The holder, to get the right, he had to pay the premium, and he is not paying premium. In this case, he is foregoing his interest, foregoing his coupon, thereby he is paying the premium. So writer, like a issuer company here, if you are a writer, you would have received some benefit for giving the benefit of holder. You would have received the option premium. You are not receiving the option premium directly, but you are saving your interest cost. Like that, you are getting the benefit. Hope you are getting the overall concept. Okay, let me write it for you so that you'll get one more clarity. Again, this is not required for exam. I'm doing only for your benefit, not required for exams. Normally, in a call option, what would happen? In call option, what would happen to the holder and other position writer? Holder gets the right. Holder gets the right because he can buy later. He has the choice, and the right does not come free of cost. The holder has to pay premium. Pays premium. Now, in the case of convertible bonds, also the holder is getting the right. The holder is getting the rights. The right to convert. He can decide when to convert. I mean, whether to convert or not. He is getting the right. Getting the right. And he is paying premium. But how is he paying premium? Not by way of cash. He is paying premium by way of the interest forgone. By way of the interest forgone. Interest sacrifice. Interest sacrifice. Writer, he would have received premium, right? Writer received premium as consideration. Receive premium as consideration. Received premium as consideration. And writer here, here it's not writer, here it's a company. Here it's the company issuer. And here holder is the bond holder. Bondholder. Now, issuer point of view, how is he receiving premium? Is he receiving premium? Directly is not receiving cash, but he is receiving premium in the form of receiving consideration premium in the form of saving in interest. The form of savings in interest, and that is what is we are recognizing it as a equity component. Equity component. And that saving in the form of interest savings, you recognize interest component. That means the saving is no longer there. So correspondingly, the additional interest will be recognized every year. We will look at this once more. You will get more clarity when I show the actual table, how the calculation is going to take place. There you get the idea. But as of now, I hope you got the overall concept. What is this equity element? Is it fine, my dear friends? Did you get this point? Did you are you able to compare the SFM concept and FR concept here now? Okay, I'll go back. And again, just for reference, in your SFM, this debt component, what is it called? Pure cash flows, pure coupons, discounted using non-convertible coupon rate. What is it called in SFM? It is called as straight value of bond. Straight value of bond. Straight value of bond in SFM, convertible bonds. Total proceeds is the market price of convertible bond. Market price of convertible bond. And then we find the difference. Here we call equity component. Do you remember what is this difference used to be called in SFM, in convertible bonds, bond valuation chapter, security valuation chapter? The difference between market price of convertible bond and straight value of the bond. What is used to be termed as? Anyway, uh, that's not called as floor value. Floor value is straight value. The minimum value is called as straight value. The difference is not called as floor value. The difference between market price of convertible bond and straight value of the bond is called as downsize risk. Downsize risk. But we used to convert this into percentage. We used to divide by the straight value of the bond and we used to say percentage terms. But conceptually, the difference is the downside risk. Conceptually, what is the downside risk? Even if conversion don't have value, this value is guaranteed straight value. This much minimum value you get straight value. That's what's called as floor value. Minimum is guaranteed. And difference between those two, that is the risk you can expect even if the company becomes useless. Conversion option becomes deep out the money, not likely to be exercised. Still, bond will have straight value because it will have the ability to generate cash flow. So, pure cash flow point of view, when you do discount, that's what is called a straight value of the bond. And here difference is called as equity. That's what is being called as downside risk, the convertible. So let's go backwards. Hope you but this is what is required for exam point of view. So as on this date, what is journal entry will write, that also will write down, because sometimes they'll ask journal entry on 1/1/2011 on issue. Journal entry would be bank accounts, debit amount proceeds 1 crore, 2 8% debentures within brackets debt component. ₹87,84,920 to 8% debentures equity component, that is 12,15,080. And where will you transfer to the balance sheet? 87,84,920 will go to long term borrowings, non current liabilities. And where will 12,15,000 will be transferred to? And this will be transferred to your other equity, reserves and surplus. It will be shown under other equity, and it is not a free reserves. Keep it in mind. It is not free reserves. Only when debentures are closed, that equity component would be available, and then you can make it use for other purposes. Till then, it will be not a free reserve. Okay. Okay. Hope you have taken down till here. Just for our referential purpose now, what will happen every year? Let's try to understand only for our reference purpose till the last year. And last year, if the settlement happens on delivery basis, what would happen? I mean, on a conversion basis, if settlement happens on cash base, what will happen? That also we will discuss. Okay. So we'll say amortization schedule. Amortization schedule. Like year, opening, interest cost, finance cost, then cash flow, the payments, closing balance. First year, 2011, opening. How much is going to be your debt component? We just calculated 87 lakh 84,000. Can use this. Prepare the table. Let's discuss this one. Okay, amortization schedule. So year, opening balance, finance cost at 12% market rate, coupon paid, amount outstanding at the end. You start from 2011. Amount outstanding at the beginning, we just calculated 87, 84, 920. On 12% on which amount are you going to calculate? 12% on 87 lakh 84,920. Opening balance 1094 190. Why? Because that is the required rate of return from investor point of view. That should be his income. And how much you paid? Coupon 8 lakh. So journal entry wise, if you want to understand, the journal entry will be finance cost, account debit to your 8% debenture debt portion. And this 8 lakh what journal entry we pass. You are making a payment like a repayment. It will be 8% debenture account debit to bank 8 lakh. Effectively, what is happening? Effectively, some people also pass one direct entry. Instead of passing two separate entry, they'll pass on direct entry. They say to bank 8 lakh and finance cost 87 lakh 10 lakh 54 190, and balancing figure, the extra amount they will transfer it to 8% debenture debt portion, that is 2 lakh 54 190. You can pass these stream of entries or you can write together. Okay, let's do one thing. Let's pass the entry for the first year at least. For other years not required, only for first year at least. Let's not write in this table. Let's write in the second table. Okay, the entries in 2011. What entry would pass? Two alternatives are there. Alternative 1, You can pass finance cost account debit. This you also write down journal entry. 10 lakh 54 194 190, 12%, that number. 2, 8% debentures. Brackets, debt. Ten lakh 54 190. And one more entry you pass, that is payment. 8% debentures, debt, coupon paid 8 lakh, to bank 8 lakh. Alternatively, one entry only will pass, that is finance cost 10 lakh 54 190, to bank 8 lakh. That excess amount is there, that they will transfer it to 8% debentures. Effectively, that is the increase in the debentures. Effectively, that is the amount not paid. That is the amount you are saving. This is the amount you are saving. But this saving is the cost you are showing now, and at the beginning you are shown as the interest cost. At the beginning you shown as the savings equity component. So to 8% debenture, debt portion is 2 lakh 54 190. Okay, hope it's clear. Both entries are fine. One entry is faster, of course. Okay, we'll come back. So how much will be amount outstanding at the end? 87 lakh 84 920 plus this amount what we calculated, 2 lakh 54 190, or you can also do 87 84 920 plus 10 lakh 54 190 minus 8 lakh, that will come to 90 39 110. Just to tell you how this account will flow over a period of time. So 2012, this 90 lakh 39 previous closing becomes opening balance. On that you apply 12%, 8 lakh anyway you pay coupon, and amount outstanding at the end becomes 932380. So 90 39 110 plus 10 lakh 84 693 minus 8 lakh, that will give you 932380. Like this, you prepare for next 2 years. Okay, hope you got it. Okay, let's see if you're able to get these numbers. 2013, 90 lakh 23. On that 12% interest, 11 lakh 18 856. Coupon paid 8 lakh. Amount outstanding at the end become 9642 659. 2014, amount outstanding at the beginning 9642. And here I will not do 12% because last year, no. Last year I have to get 100 lakhs. This is my liability amount ultimately. Therefore, this number you do as balancing figure. Because of round off, let's do some mathematical adjustments. So this 11 lakh 57 will be a balancing figure. A balancing figure. You see, ultimately it's coming to 100 lakhs. Now, if you did not follow this, okay, now ultimately finance cost will go to P&L account. The coupon payment will go to cash flow statement because cash flow in nature, and amount outstanding at the end will go to balance sheet as a financial liability debt component. Now, if you don't follow this under present factors, if you don't follow this, then what you would have done? How much amount of debt amount you would have recognized? The equity conversion option you would not have worried at all. You will recognize that entire amount at 1 crore. Finance cost, how much you recognize? 8 lakhs. How much you make a payment? 8 lakhs. So closing balance, how much will come? 1 crore. That's the same second year also, third year also, fourth year also, fifth, last year also. So ultimately, what you reach is same. Are you understanding? Ultimately, what you reach is same. 100 lakhs, 100 lakhs. Please write down. Then we'll write down the observations for our understanding concept. Please write down. Okay, hope you are able to write it down. Please do the total of this cost also. When I say under present practice, that means without applying this split accounting, without applying Ind AS 32, what would have happened? Even under that case, ultimate amount of liability would be same only 100 lakhs. That is not differing. Once you write down, please confirm. Okay, hope you written down. Okay, now let us observe, let's discuss, then we'll write down. Now, can you please tell me what is difference between these two number, 44 lakh 15,080 and 32 lakh? What is the difference between these two numbers? The difference between finance cost amount and the actual coupon paid you should have taken. If you not applied this, that 12 lakh 15,080, right? And that is exactly the amount of equity which you have recognized at the beginning, equity portion. Hope you're able to connect mathematically also. Let's connect it once more. Because of following Ind AS 32, we are applying substance over form. The substance over form is, in the form you are paying only 32 lakh. But in substance, you are paying 44 lakh. How are you paying 44 lakh? Because you would have paid the amount and you had sacrificed the amount. In the sense, you would have paid this amount. But because you are giving the benefit for the holder, you are paying short. In form, you are paying short. In substance, you are paying more. So, whatever the market rate of interest, you show it. Interest expense also shown separately. The equity portion also recognized. In the sense, debit also increased, a credit also increased. If you have not done, it would have been set off other way. Suppose you sell goods to one person worth 1 lakh, other person gives you 1 lakh, effectively 1 lakh exchanged. But what does the substance says? Your 1 lakh is revenue, the other 1 lakh is expense. You can't net it off. You have to show both of them. Suppose you have sold goods. Instead of paying rent, you did not have money. You sold goods to him. So what entry you are going to pass? Can you say rent, I will not account, and sold goods, I will not account? Both are set off each other. No, rent I've saved, I don't have to pay. Why? Because I've issued goods. So can you say like that? For goods I don't account for the income, for the rent I don't account for the expense. It is not right. Those two are different nature, right? If you do, what will happen now? Overall profit remains same, but what will happen? Reporting of sales, reporting of expenses is different thing. So what you should do, you have to recognize rental expense, you have to recognize sales. Then you set off. But rent expense should be shown and sales income should be shown. Similarly here, because you're sacrificing interest, don't say I'm sacrificing interest, notional in nature, don't account for it, nothing doing. Nothing doing. You're saving interest, show the income. You are showing income. Then whatever expense you would have paid, show that also. So an equity element also recognized, and interest expense also recognized. Effectively, the journal entry is expense account debit to reserves and surplus, expense account debit to equity. That equity is recognized at the beginning, the expense is recognized over a period of time, which reflects difference between the two amounts every year. Did you get the point? Question you want to ask before we write some sentence? All this much may not be required for exams, but conceptually, rather than just doing it mechanically, learning concepts will always give more confidence, because they can make some twisting and turnings in questions. Once you are conceptually confident and clear, any changes they make, you will not be worried about it. Because normally they say compute debt and equity component. In one of the exam which I wrote, what happened? They had given you total proceeds, they had given you debt component, and they had given you equity component. We had to calculate total proceeds. They have not given number of units. Something and all was complicated, but conceptually, if you're stronger, you will be able to do it. That problem also will do it. Don't worry. Did you get the point? Okay, let's write down. Okay, let us just write down overall analysis only for our reference. Okay, overall analysis only for our reference. Okay, so in under Ind AS 32, substance over form is applied by recognizing equity component. Equity component. In form, that is in legal terms, that is actual cash flow. In form, it is 8 lakh into 4, 32 lakh. In substance, that is interest accrued, it is, we calculated 44 15 80, 44 15,080. Difference represents 12 lakh 15,080 is the difference. Let's write down difference equals to saving in interest cost equal to the equity component. Okay, this is the different. This is the interest cost savings due to option of conversion given to holders. Given to holders. If this is not accounted, then it would mean the consideration received by the issuer and interest expense payable by the issuer would be netted off. If this is not accounted. This is not accounted like this. Okay. So by recognizing equity elements at the beginning and interest expense and additional interest expense over a period would reflect both income and expense on a gross basis. On a gross basis. On the gross basis. Okay, so effectively, equity recognized at inception. How much? 12,15,080. Okay, and additional interest costs. Every year you calculate. Year 1. How much you paid? What is the amount first year? 10 lakh 54 190. 10 lakh 54 190 minus 8 lakh. That is 2 lakh 54 190. Year 2. 10 lakh 84 693 minus 8 lakh. 2 lakh 84 693. Year 3. 11 lakh 18 856 minus 8 lakh. 3 lakh 18 856. Year 4. How much year 4? 11 lakh 57 341. 11 lakh 57 341 minus 8 lakh. 3 lakh 57 341. Please do the total. How much total you get? Please do the total and tell me. Same number I think you're getting. 12 lakh 15,080. So what is 12 lakh? This equity portion, it is a credit to other equity. Credit to other equity. And these are things are debit to P&L. Right? Effectively, overall, your other equity would remain same. Your reserves and surplus net worth of the company overall is not affected. But every year, reporting matters. Every year, P&L account matters. Every year, interest cost matters. Every year, interest coverage ratio matters. When interest cost is different, your ROCE, your ROE, interest coverage ratio, debt equity ratio, you see so many ratios are going to be influenced because of this accounting. Overall, maybe zero, but interpretations, positions, utilities, all those is going to be completely different. Hope you got this one. Okay. Let's move forward, what else they can ask? Few more adjustments towards this question. Let's discuss about that. Joint is 2011 we discussed. On maturity also we'll discuss it. Okay, on maturity. On maturity, let's say if everybody opted for repayment on cash, redemption happened on cash basis. Everybody said cash basis. Then what entry will pass? Anyway, 1 crore we have in debt. To cash or to bank, 1 crore. Sir, what will happen to the equity? Now that becomes free reserves and that will be to other, we can say retained earnings. That will be transferred to retained earning. That will be transferred to retained earning. So basically, any unutilized amount of equity, that equity component what we discussed, now becomes free reserve because it's no longer required. This concept we are going to use in share based payments also, keep it in mind. Okay. Now, if 100% is done by converting into debenture, then 8% debt will be converted into share. And how many shares we discussed? It is issued at what ratio? It is at a face value. I told you to take, right? Face value. I told you to take it at 10 rupees. Yeah, face value I told to take it at 10 rupees. And the ratio is 1 is to 1. So, how many number of debentures you get? Number of debentures 1 crore divided by 100 rupees, which means 1 lakh. And number of shares also same thing because they said 1 is to 1 basis, fixed for fixed, number of shares also 1 lakh. And face value of 10 rupees. That's how you get 10 lakhs. Number of shares 1 lakh into 10. 10 lakhs, 1 lakh shares. So 1 lakh debentures, 1 lakh shares. 1 crore is the consideration. 1 crore is the face value of debentures. Face value per debenture 100. So total 1 crore by 100 means there should be 1 lakh debenture. Conversion ratio is 1 is to 1. Fixed ratio. So 1 lakh debenture means 1 lakh shares. And face value of equity share is 10. I told you to assume. Just for discussion purpose, I told you. Exam they should give you. Otherwise, you can't assume. Anyway, so 10 lakh is the equity share capital. Balancing figure will be transferred to security premium, including this equity component. Debenture face value 1 crore. Here 10 lakh. So that 90 lakh will become security premium. Plus this 12 lakh, what is the equity component you recognized, that also will become security premium. This is 100%, 100%. If 50-50 converted, proportionately everything will be taken. Proportionately you transfer it to reserves, proportionately you transfer it to security premium, like that. Okay, is it done? I'm just trying to understand. We're just trying to understand whatever possibility that can happen. I just want to do it for this one problem. Though it takes time, to give you clarity. Fine. Okay. Now one more thing can happen. That also I'll discuss with you now itself. If transaction cost is there, then how it would be accounted. Now this discussion what we have now will also be applicable in other areas. So let's understand. In the next chapter when we discuss about classification, recognition, derecognition, this will help us. Here only, though it's useful in other concept, I will cover here itself, everything in one place. If the issue of debenture had a flotation cost of 1,31,000, please write down the heading. It's a situation, it's a scenario based we're discussing. If the issue of debenture had a flotation cost of 1,31,000, then you know what we'll do? This financial instrument had a flotation cost. This flotation cost should be allocated to whom? What do you think? This flotation cost should be allocated to the equity or should be allocated to the debt? What do you think? This flotation cost should be allocated to which one? It should be allocated to both. Absolutely right. In which ratio? In the debt equity calculation, what we did. So we had calculated the debt component 87 lakh 84,920, equity component 12 lakh 15,080. The flotation cost should be allocated on proportionate basis. Divide 1 lakh 31,000 in the ratio of 84, 87, 84, 920 for debt, 12 lakh 15,080 for equity. Please distribute. So 1 lakh 31,000 into 87 by 100, 1 lakh 37,000 into 12 by 100. This cost will be allocated. Please write down. Okay, hope you're done till here. Okay. Now, this, okay, what entry do we pass for this? That's also we'll understand. Flotation cost account debit to bank 1,31,000, and debt component transfer to debt, and equity component transfer to equity component. So effectively now equity component will reduce. I'm getting one question. What if there is a certain part specifically attributable to equity? How is it possible? You're having convertible debentures. Convertible debentures, you will have flotation cost like underwriting commission, stamp duty, legal charges, credit rating charges. These are all applicable for convertible debenture. How can you say applicable to equity specifically? And this is we are doing only in accounting purpose. That is for reporting. But in the world, if you take convertible debenture is one instrument. They are not aware of equity, how much, debt, how much. So no question of specifically attributable to equity do not arise. Hope you got the point. It's only for the substance over form. For a reporting purpose, we are doing like. Okay. So now, so what will happen now? When you allocate it, your equity component will be reduced. Your debt component also will be reduced. Okay. So your revised equity component and revised debt component both will be revised. So your debt component will be reduced by 1,15,082 and equity component will be reduced by 15,918. So equity component 12,15,080 minus 15,918 and debt component will be 87,84,920 minus 1,15,082. Let's write down that also. Revised debt components 87, 84, 920 minus, okay. Hope you understand it, why it is minus. Because this is a liability element, credit item. Debentures debt was credited. Debentures equity element was credited. Now you're debiting it. Flotation cost is debit item. So credit item set off with debit item, it will reduce. A liability adjust with a debit, it will reduce. Means what? Flotation cost will not be transferred to P&L account, mind it. It will not be transferred to P&L account. So 87, 84, 920 minus 1,15,082. $86, 9, 838. Revised equity components. Uh, 15, 12 lakh 15,080 minus 15,918. 11 lakh 99 162. Effectively 1 crore minus 1,31,000. These two. Okay, anyway. Okay, so now, yes, I'm coming to your question. That's what I was about to ask the question. Now, when we talk about amortization schedule, on what amount will you apply 12%? Will you apply it on 87, 84, 920, or will you apply it on 86, 69, 838? This situation would have come not only in this problem, any problem where there is a debt has a flotation cost. This issue would have arisen there. Any problem where a debt, a loan, there is a issue cost, loan processing charges, this issue would have come. Hope you're getting the problem. Now tell me, will you apply 12% on the original amount or 12% on the revised amount? What do you think? What should be the correct method? It should be on the revised amount. Correct, revised amount only, because every year amount will change, right? Opening balance plus interest minus payment, closing balance, every year amount will change. But there is one mathematical issue that is going to happen when you apply it on revised amount. There is going to be one mathematical problem. Okay, what is that mathematical problem? We will discuss after the break. So take a break of 10 minutes, then we'll discuss. Okay, let's move on now. So what we're discussing, when you have flotation charges, flotation cost, transaction cost, not only in this case but any other debt, when there is a transaction cost not taken to P&L, you adjust it in the liability gets reduced, correct? And now there is going to be a problem. What is that problem? How did we recognize 87, 84, 920? Let me just take you back what we're discussing so far. Okay, so how did we calculate the debt value? We took the cash flows of year 1, right? Year 1 cash flows we took 8 lakh. Year 2 cash flows we took 8 lakh. Year 3 cash flows we took 8 lakh. Year 4 we took 8 lakh also, and redemption price of 100 lakhs. Total it came, and we discounted. All of them we discounted, and today value that became 87 lakh 84 920. We discounted at 12% discounting rate. 87 84 920. And now we prepared amortization schedule on 87 84 920 plus 12% we did minus 8 lakh plus 8% minus 8 lakh plus 12% minus 8 lakh plus 12% minus 8 lakh. So this was ultimately came to 100 lakh, correct? Because that's how we calculated. Now because of the transaction cost, what is happening, you are doing not 87 84 920, you subtract 1 lakh, this 15,918, sorry, 1 lakh 15,982. It revised amount became 86 69 838. 86 69 838. Now, on this also, if I keep charging 12% every year, do you think 100 lakhs will come after year 4? What is your opinion? When we discounted all those cash flows plus 100 lakhs at 12%, we got 87 lakh 84. On that, we kept on adding 12%, subtracting 12%, 8 lakh, adding 12%, subtracting 8 lakh, adding 12%, subtracting 8 lakh. Ultimately, we got 100 lakhs because that was the value we calculated. Now, because I'm revising this amount to be 86, 69, 838, will you still get 100 lakhs after 4 years? What do you think? It will not be 100 lakhs after 4 years, but we want it to be 100 lakhs after 4 years. It should be 100 lakhs. But if you do with this 12%, it won't be 100 lakhs. It won't be 100 lakhs. Now, I cannot change 86, 69 and 38. That is fixed. My 8 lakh, 8 lakh, 8 lakh, 8 lakh, that is fixed. And 100 lakh on last year, that is fixed. Then what is the only element which I can change? What is your opinion? What is your take on this? Today value I computed already 80, 69, 38. That cannot be changed. On that amount only I want to add interest. Last year I want it to be 100 lakhs. Every year I want it to be 8 lakh. That is not permissible to be changed. Then only thing is change your interest cost, meaning change your rate of. That's what is called as effective rate of interest. So you make present value as 86, 69, 838. Year 1 should be 8 lakh. Year 2 should be 8 lakh. Year 3 should be 8 lakh. Year 4 should be 8 lakh, and last value should come up to 100 lakh, because these are all committed cash flows, cannot be changed. Now you when you discount, you need to get that rate. You need to get that rate such a way that present value comes to 86, 69, 838. Okay, now one mathematical term. We will calculate anyway. I'll show you how to calculate. But do you think that rate would be more than 12% or less than 12%? What do you think mathematically? At 12%, we got 87, 84, 920. Now it got reduced when the present value 87, 84 became 86, 69. What will happen to rate of interest? Your SFM concept. Rate of interest is less or rate of interest is more? Mathematically, I'll give you logic also afterwards. First, SFM concept. At 12%, we got 87, 84, 920. And now it became 86, 69. When the present value reduces, what will happen to rate of interest? Less than. That means you have absolutely no basic knowledge in financial management. I can give it to you in bond writing. The fundamental basics in financial management is there is inverse relationship between present value and rate of interest. That is a fundamental thing, because we always divide discounting factor, though multiply, it's actually divided. In SFM also, you would have, I'm sure your SFM faculty would have shouted and told you, YTM and market price, they are inversely related. You'll always have a downward curve. What, even in general, rate of interest is always inversely proportional to present value. Why? Because present value is future value divided by 1 plus r, and 1 by 1 plus r is discounting rate. Though we multiplied by discounting factor, its effect is division. Forget about all those things. If you don't know, please take your SFM classes once more and start fresh. I can guarantee you, if this much you don't know in SFM, cannot do anything in SFM. And if you don't know in SFM, understanding these concepts in financial instruments becomes even more difficult. I'm extremely sorry to say that. Anyway, so concept is 87, 84, 920 at 12%. Now it reduced, 87, 84 became 86, 69. When the present value reduces, the rate of interest should increase. It should be higher. That is one logic. Now let me come to FR logic. Why it is reduced? Because of flotation cost, which means instead of transferring the flotation cost, I transfer it to liability. I mean, instead of transferring the flotation cost to P&L, I've transferred it to liability, in the sense my annual financial cost will not only include the regular interest but also include this transaction charges. So effectively, what goes to my P&L account should increase every year, not only the previous finance cost, but also the component of the flotation cost. So effectively, the rate of interest should anyway. So that, in my opinion, it's a serious flaw. You are understanding that when the rate of interest reduces, present value also reduces. That is definitely a serious issue that need to be addressed. Please take care is what I can tell. Anyway, so let me go further. Let's write down. So you can write down, when the flotation cost is adjusted, amount will be reduced. However, if interest charge is 12%, the liability will not reach 100 lakhs. Hence, interest rate need to be calculated, recomputed. You can say implicit rate, you can say effective interest rate, or you can say YTM, such a way that the present value of cash flows will be equal to 8669,830. And how do we do it? I really don't expect you to remember, but ideally you should remember if you want to pass SFM exams. So at 12% we get 87, 84, 920. At what percent we want 86, 69, 838. Write down till here, then we will calculate. Okay, hope you got it here. Now, the IRR method, YTM method, what or maybe, or popularly it is called as interpolation method. At 12%, we got 87, 84, 920. What should be the rate? 86, 69, 838. We'll assume one rate. We get one more number. And between 12% and that number, and between 87 and that number, we'll try to interpolate. Uh, Ideally, I wanted to you to try it, but based on the previous answer, I don't have that courage to ask you to calculate this rate of interest. I will calculate for you. At 12%, we 87, 84, 920. So now what should be the rate at which 86, 69 should come? We need to assume a higher rate. And if you assume lower rate, you keep on doing it, you will never get the answer. God bless you. We assume higher rate, let's say 13%. So 13%, let's calculate. The present value, if I use year 1 to 4, 8 lakh every year. At 13%, I think I get 2.974 by 1 by 1.13 equal to 4 times GT. Last year discounting factor, total comes to 85 lakh 12,600. So at 12%, We got present value as 87, 84, 920. At 13%, we get 85, 12,600. But we want 86, 69, 838. So what should be the rate of interest? Though we are calculating this in the case of compound financial instrument, this discussion holds good for any debt instrument where there is a flotation cost which will result in effective rate of interest. So 12 to 13% means the uh, journey or the difference is 1%. And similarly, what is the difference from 8784 to 8785? The difference, or I'll just show it here. So for 1% difference, 8784 920 minus 85 12,600, 2 lakh 72 230, 2 lakh 72 230. That is for 1 full percent difference. But I don't want full 1% difference. I want to come only till 86 lakhs only. That difference only I want. 87 84 920 minus 86 69 838. 1,15,082. So 1% change means 2,72,230 is the difference in present value. So what percent change you get? 1,15,082. Cross multiply 1,15,082 divided by 2,72,230 into 1. Get 0.42, I believe. Therefore, effective rate of interest, implicit rate of interest is 12 plus 0.42 because we are increasing 12 to 13. So it becomes 12.42%. You know what effective that 0.42 is all about? This 0.42 will reflect flotation cost. Reflects the flotation cost. Transferred to P&L over a period of time. I'll show it to you how it happens over a period of time. But in your FR paper, they will not ask you to calculate effective rate. That they will not do in exams because it's part of SFM. They assume you know it in SFM. They don't know that you would not have learned it there also. But they assume that's a basic thing. That's why in FR, they will not ask you to calculate this. In fact, in many study material questions, they have given the solution directly. They have not shown how the effective rate of interest is calculated. They have shown directly the problem they take, the solution they say for the above problem, effective interest rate is so much, and they give you the answer. And student always get confused. How this effective rate of interest is calculated? I used to tell earlier also that in SFM you learn. In SFM you learn. You know the you know understand by your own answers how it will be. That's why I am showing you the answers now. How the effective rate of interest is calculated, like YTM, like IRR, like implicit rate of interest. Okay, I'll also show it to you how people do it. How do they do it in practical life? How fast they can do it in practical life? Let me show it to you that also. Uh, Seconds. Okay. Uh, can you please confirm? Is the Excel visible? It's visible, right? I also getting one question. Let me confirm it. Flotation should cost should not be transferred to P and L, right? Yes, it should not be transferred to the P and L right away. Immediately, it will not be transferred. But when you compute at this 12.42%, effectively it will go to the P and L account every year. What is the logic behind that? This is an expense relevant for loan. So it should not go to the P&L account in 1 year. It should be amortized in P&L account every year, but not divided by 4. It will be effectively part of the finance cost indirectly. It's like a interest expense paid in advance. So you're adjusting the liability. It's also a cost. But though it's paid immediately, should not be transferred to P&L immediately. It should be transferred over a period of time, because the loan, the instrument is there over a period of time, and whenever that finance cost goes to P&L, this flotation cost also should go to P&L. I'll show it to you how effectively it goes to P&L. You will get more clarity there. Let me just quickly show you to you now how it will be calculated in Excel quickly. Well, okay, so here we are having, okay, year cash flows. You write how many years we had. Year 1 2 3 4. I'll start from 0 0 1 2 4. And what are the cash flows? Every year payment, how much? 8 lakh. Second year payment 8 lakh. Okay, I'll do minus because 8 lakh 8 lakh, no, minus payment 8 lakh. Okay, third year also 8 lakh. Last year 108 lakh. Okay, now what is the amount you received today? How much amount you received? 87, no, revised amount now, 86 69 838. 86 69 838 you received. So how do we calculate? In Excel, very simple, equal to IRR, you select 12.42%. That's all the formula. Equal to IRR, select the column, you get the answer. That's how the ICA Institute would have solved your FR paper in your all the study material questions where effective rate of interest is involved. Simply using Excel. And how do we do in examination? If at all they ask, for your understanding, without Excel, interpolation method, which we did now. But effective interest rate, hope you got the concept. In some other problem, in some other areas, if they mean effective interest rate, this is what they mean. Not only in compound finance instrument, in any instrument, effective interest rate would mean this. Okay. Okay. Is the PPT back now? Yes. Okay. So we calculated 12.42%. Let's prepare one amortization schedule now with the revised amounts. Let's see if the amount will come correctly. Amount outstanding at the beginning Finance cost at 12.42%. Coupon paid, amount outstanding at the end: 2011, 2012, 2013, 2014. Amount outstanding at the beginning on that 12.42%, revised number, new number, 10 lakh 76,784. Coupon anyway paid 8 lakh. Amount outstanding at the end 894632. That is 86,693,838 plus 10 lakh 76,794 minus 8 lakh will give you 894632. Interest got added. The payment means the liability will reduce, so subtract it. Like this, you please write. See if you're able to get the point. Okay. Hope you're able to do it. So for the 2014, it is 96 7623. Last year, if you apply 12.42, you get approximate number, but you please round it off. So balancing figure 11 lakh 92 377, correct? And ultimately you will reach 100 lakhs. Ultimately you will reach 100 lakhs. Okay. That's what happened here. Please see if you are able to do it till here. Okay. Okay. So we got now this amount. Just for reference, this is the finance cost at 12.42%. What was the finance cost? We got it at 12%. Quickly copy it down. Please rewrite it. At the previous table we got it. We prepared earlier, no? Previous table. Finance cost at 12.42%. Please rewrite in separate column. If you have space in the same table, you can write it. I just want to show you the difference and what exactly that would mean. Finance cost at 12.42%, which we got it now. Finance cost at 12%, which we got it earlier. And again, I repeat, don't think so much thing will come in one problem. How to do it in 3 hours examination? This question for exam purpose done long ago. 5 minutes only, it's over. I'm just doing it in exhaustive possible manner. So other problems we can do faster. That's the intention. So find out the difference for each year. 10 lakh 76 794 minus 10 lakh 54 190. 22,604. 11 lakh 11,172 minus 10 lakh 84 693. 7 lakh 11,172 minus 10 lakh 84 693. 26 479. 11 lakh 49 819 minus 11 lakh 18 856. 30,963. And 11 lakh 92 377 minus 11 lakh 57 341. 35,036. Okay. Now please tell me the total of this difference. What does it comes to? 1,15,082. And was this the flotation charges allocated for this one? Exactly. 1,15,082, right? Same amounts. Was the exact same amount. So 1,15,082 you can mention is the flotation charges. Flotation cost attributable to debt. Hope you are able to get this point. That 12 to 12.5%, 12 to 12.42%. Why that 0.242% increased? Because of the flotation cost. Instead of transferring the flotation cost to the P&L account in 1 year, we will transfer it to the P&L account over a period of 4 years. Not in the ratio of equal 1 by divided by 4 as a part of interest, as a part of uh, interest cost, effective interest cost. Flotation cost attributable to debt. So one of you are asking the question, how the flotation cost goes to P&L? Like this, it goes to P&L as a part of finance cost. This is what we mean by effective rate of interest to include flotation cost. These things will come in Ind AS 109 in recognition chapter, I mean next standard only. But I'm just covering it now. At that point in time, I'll not be repeating in detail. Hope this is fine. Okay. There's one more point to be considered. Let's discuss it now itself. So we discussed how to break it up separately, how interest cost will be recognized over a period of time, what is the logic behind that, and if there is a flotation cost, how to distribute, and what is the impact of effective interest rate. All those things we discussed. Okay, I'm getting one question. Let me read for you. Any incidental charges relating to loan should also be attributable to both. Absolutely. Incidental charges means the flotation charges, transaction cost, underwriting expenses, legal expenses, lawyers' fees, stamp duty charges, credit rating charges, anything. All these are the expenses which are relevant for the loan processing charges, you can say, are part of effective interest cost. Because when we say interest cost, even your AS16 will tell you indirectly. Even when you issue, indirectly we'll take it, but even otherwise, the concept you would have learned. I don't know whether you remember now. When you have a debenture premium, debenture redeemable, debenture issued at discount on issue of debenture will not be transferred to P&L account in 1 year. It will be amortized over a period, right? Issue charges, even income taxes, issue expenses on debenture, even equity shares they allow it. But as per India's, the amount relevant for equity item, like this what we discussed, will not go to P&L. Only relevant for the debt item goes to P&L, not in 1 year, over a period of 4 years. But what happened to equity component? The flotation charge is relevant to equity component. It adjusted in equity only. That's what even they say. If you issue equity shares, to raise money by issuing shares, there is a flotation cost, will not be transferred to P&L. It will be adjusted directly in equity in the balance sheet. It will not go to P&L. That is just consistent effort, because the dividend paid on equity shares, it comes to P&L. No, it will come to the equity directly. Reserves and surplus you will subtract. But dividend relevant for preference share dividend, redeemable preference share dividend, the nature of debt. That preference share dividend will come in P&L as finance cost. Preference shares in nature of equity, will that dividend come in P&L? No. So anything relevant for debt will come in P&L, either in 1 year or over a period of some number of years. Anything attributable to equity directly will come in equity, be it issue of shares, any transaction charges, transaction expenses, flotation expense, or even in compound finance instrument, the equity component attributable transaction cost will not come in P&L, will be transferred to the equity directly, go to reserves and surplus, other equity in balance sheet. This debt component, loan charges attributable to them, even in any other pure debt instrument also, flotation cost will come in P&L, but not in 1 year, over a period of year as a part of effective interest. Even AS income tax also says it, but they say it is just simply amortized. No effective interest concept there. They simply amortize it. That's what they say. Anyway, hope you got the concept till here. Any other doubts? Will there be any deferred tax impact on books of issue? Definitely. Wherever there is a difference between the income tax profits and accounting profit treatment, every line item there will be a difference. But we don't discuss it here because you are not recognizing any deferred tax here. You will recognize the deferred tax anyway separately. But we had to discuss during business combination, because in business combination, even deferred tax component was the one of the asset to be recognized or liability. At the time of acquisition, as a part of net has taken over, so we discussed so many problems in Ind AS 103. Apart from that, only in deferred tax we discuss it. Other areas, there will always be difference between not AS Ind AS, difference between Ind AS and ICDS. Wherever there is a difference, deferred tax is going to come for sure. Hope you got the overall clarity. One more small point is there, which we'll discuss now itself, relevant for this problem. Shall we go further? Okay. Yes. Doubt is there? Get it clarified? If the company decided internal reconstruction, what will you do? Whatever the terms of the internal reconstruction says, you do it. As per the instructions, as per the scheme of arrangement. Will it affect? Depends. What are the terms of reconstruction? What are the things which are given up? In internal reconstruction, equity share people will give up something. Debenture holder might give up something. So convertible debenture people also might give up something. So whatever they give up, will transfer it to internal reconstruction account if they do it. If they don't give up anything, then nothing will be transferred. So that just purely depends on the scheme of reconstruction. Okay. Hope other doubts? Okay. Let's go on further. One small thing called as settlement, pre-settlement. If this liability was settled earlier due to some reasons, I know in our example it was supposed to be settled after 4 years. But what if they are settled earlier, how the accounting is going to happen? Let's address it now. So just give the heading, if liability, if debentures had fair value of 1 crore 5 lakhs at the end of 11, 12, 13, 2013. And settlement done at this price. Settlement done at this price. Early settlement. It was supposed to be settled at the end of 2014 either by cash or by equity shares. Now it is settled earlier. What is going to be the impact is what we are going to discuss now. It's just to recollect. If the settlement happened by cash basis, debt component to cash. Very simple. And difference between, what happened to the equity component already recognized, that will be transferred to retained earnings. That becomes free reserves now. But if it was under equity settlement, then what would you do? Then you have to do the debt component goes to equity. Equity component also goes to equity. Share capital one component. Difference, if any, will go to security premium. Second part you forget. Let's focus on first part. If the settlement happens by cash basis, the equity component would have been transferred to retained earnings. Correct? Now we are settling in cash 1 year earlier. So what will happen to equity L component? Very simple, sir. Whenever you settle it on cash basis, the equity component will no longer be required. it will be transferred retained earnings. But one caveat here, sir, one point to be remembered, sir. That equity element is the equity element provided you remain till maturity only on the last year. As on date, that is not the equity value component. You can't take it to P&L account directly. Are you getting my point? If the redemption happened at the end of 2014 after 4 years, then that equity component can be transferred to free reserves, because the entire equity component corresponding we have recognized as interest expense, so this becomes free reserves now. If settlement takes place earlier in cash, entire equity component cannot be taken to P&L, cannot be taken to retained earnings. Only the equity component as on date can be recognized. Differential amount should be treated separate. Hope you're getting the points. Just give 1 second. Okay. So basically what they're telling is, so when you make a payment as a part of this, not only the equity, the liability component would have been paid, in equity component also would have been paid. Who knows? You have to calculate. Only the excess balance pending will go to retained earnings. Will take an example for that purpose. Just write down. Uh, one more data we require. So I'll just give that. Okay. Just write down one more thing in the heading. The coupon rate of non-convertible bond as on this date. At this point, coupon of non-convertible, the 11%. Okay. So what the standard says, if the convertible or if the compound financial instruments is settled, it's actually part of next standard, but let's discuss now itself, is settled earlier than original maturity date, premature settlement, then say it in cash or in otherwise in cash, then equity components and debt components need to be reassessed on the date of redemption, and difference in debt elements will be transferred to P&L. Difference in equity elements will be transferred to retained earnings. So two simple thing. If you are redeeming it earlier, recompute debt component, recompute equity component. Whatever your revalued amount, differential amount, debt component, you can take it to P&L. That's our basic nature. Anything relevant for debt, be it interest, be it dividend in the nature of debt, will be transferred to P&L. Anything in nature of equity should be transferred to P&L account directly. Not P&L, equity directly, retained earnings. other equity. We transfer to retained earnings, which is other equity. Okay, let's calculate that in this case. So what is the carrying amount and what is the revised amount and difference? Okay. Uh, okay, so debt component, what was the carrying amount? Uh, as on 2013, the original schedule, we prepared the schedule. At the end of 2013, this is the amount, right? 9642 659, this number 9642 659, remember this number, 9642 659. 9642 659. Okay. The equity components, that will not change, 12 lakh 15,080, I think, right? That will not change. So total as on date, carrying amount, book value, 1 crore 8 lakh 57 639. Okay, and this fair value is given to be 105 lakhs as on date, which is include debt component and equity component settled on cash basis. Now we need to recalculate our debt component and recalculate our equity component. How much is going to be debt component? How do we calculate? The present value of remaining cash flows. Only remaining cash flow is one coupon. So 8 lakh, only 1 year, right? So anyway, 8 lakh, only 1 year amount into annuity factor at 11%, revised amount for 1 year only. And 100 lakh into discounting factor 11% for 1 year. I know both are for 1 year only. I am doing it just as a formality, because this recalculation what you're doing is for the remaining time to maturity, remaining period. As on this date, what would be the debt value at revised amount, revised rate at 11%? 11% is non-convertible rate. You're reassessing, revising. Remaining coupon, only 1 year pending. If 5 year remaining, 5 year coupon would have taken. If 10 year remaining, 10 year coupon you would have taken. So this only 1 year pending, I'm taking 1 year. And last year, you will have redemption price also, which is 100 lakh, I'm taking it now. Both are 1 year, you can merge it in this example. But in some other problem, 2-3 years might be pending, then you should show the present value separately. So how are you calculating revised amount? Remaining cash flow at a new rate. Revised amount, remaining cash flow at a new rate. You can mention somewhere, revised cash flows at a new rate, new discounting rate, new non-convertible rate, new market rate. How much it comes to if I calculate? Same factor only I'll get. 0.9009, right? Counting factor. So 8 lakh into 0.9009 and 100 lakh into 0.9009. So the total amount comes to 97,29,720. 97,29,720. Is the amount correct? 97,29,720. 97,29,720. The amount fine? Okay. And equity will be a balancing figure. 105 is the fair value of convertible bond, and debt component is 97. Revise, recalculate equity component, balancing figure. So 105 minus this. 7,70,280. Balancing figure. 7,70,280. Because 105 is the value of convertible bonds. Pure debt component as on this date 97 lakh. So balance 7 lakh represents equity. So entire amount 1,05,000 is paid, but the difference is what we should treat it now. Now 96 carrying amount, revised amount 97. So what is the increase? 87,061, right? 87,061 increase. Whereas in equity component, what is happening? Decreased. So here it is increase. And in equity component, decrease. That's why we need to calculate separately. How much decrease? 12 lakh 15 became 7 lakh 70. 4 lakh 44. 800. Net, if you calculate, you can do both ways. Net amount is how much? Net decrease. Three lakh 57, 739. Net decrease. Are you understanding? Difference in the debt component we transfer to P&L. Difference in the equity we transfer it to retained earnings. P&L is a loss, increase in liability is a loss, but decrease in equity is going to be a profit. And net amount we will transfer it. Let's quickly pass journal entry for this one. So this portion will get completed. Okay, let's pass journal entries now. Journal entries for premature redemption. So 8%, or first let me simply write 2 bank. Amount you are paying, that is 1 crore 5 lakh, 105 lakh. You are paying this. 2, 8% 8% debenture you're debiting. 8% debentures. Debt component. How much you are debiting? Book value 96, 42, 659. Correct? But this is not the amount you are paying. You are paying the revised amount. So there's a loss on loss on the debt revaluation, loss on the debt components. How much amount? 87,061. And equity component is to be closed, right? 8% equity component, 8% debentures, which is equity component. I'm passing one component entry, you can pass two separate entries also. Equity component as on date, 12 lakh 15,080. But you're not paid fully. You had some profit here. So, two retained earnings. The difference, profit amount relevant for the equity component. How much you got? 4,44,800. Because liability reduced. No, you out of. Let me show you to you once more. Out of 12 lakh 15,080, you settled only 7 lakh 70,280. Let me explain you once more. Please concentrate in case you have not got it earlier. Debt component book value 9642, but we have to pay 9720 as part of 105. So increase 8761 is going to be a loss. That's the entry we are passing now. Debenture book value 9642, but payment include in 105 is revised amount. So loss recognized 8761. So 9642 plus 8761, which means 9729 is part of 105. And equity component 12 lakh 15 is also to be closed. But how much you are paying? You are paying only 7 lakh 7280. Balance you have a profit. Excess amount is there. The excess amount will be transferred to retained earnings, which is 4 lakh 44 600. 4 lakh 44 600. 800. 800. So you had a shortage, loss in case of debt, but equity you had a surplus. So loss on debt transferred to P&L like a loss expense, and surplus in that is the equity component will be transferred to retained earning. See if the entry matches first of all. 6, 42, 9 revised, resulting in loss of 87,061, which is 9729 720 our revised amount, plus 12 lakh 15,080 minus 105 4 lakh 44 800. I'm passing one straight entry. You can also pass two separate entry for debt component separately, for equity component separately. That way also you can do it. That is left to your choice. I'm passing one compound. Go through it. If you have any doubts. Okay. Hope you got it. This is your complete picture relevant for compound financial instrument. We have gone beyond what they usually ask in exams. In exam, usually what they ask, separate the component. Worst case, partial entries. But in your textbook, in your study material, and also part of the standard, these components were there. We have discussed everything at length, detail. So going forward, we'll be doing faster problems. Let me know if you have any doubts. To the extent of revised figure, equity is issued at face value. No, the amount is settled. Amount is paid in cash. So the equity component is also paid in cash effectively. Hope you're getting the question. You are paying 1 crore 5 lakh, 1 crore 5 lakh, which includes debt component of 97, equity components of 7 lakh 70. Both are paid in cash. So 12 lakh 50,000 equity component, out of that 7 lakh 70,880 paid in cash. So remaining surplus you have transferred to retained earnings. As per debt component, you had 9642,659. As per liability, you paid 9729. You paid more. The excess amount paid more is transferred to P&L account. Both are settled in cash basis. Can it be settled? Can it be settled in shares prematurely? It can be settled. We are going to follow same process. Revise the debt component, revise the equity component. The debt component revision will be transferred to P&L. Equity component revision will be transferred to retained earnings. I mean, if they is settled in equity shares, ultimately it will be transferred to, I mean, the whatever equity component will be transferred to security premium. The excess portion will be going to retained earnings. If they settle in shares prematurely, of course, both parties should agree. Whether prematured in cash or prematured in shares, both parties should agree. But the process remains same. Debt component should be revised. Equity component should be revised. The difference in debt component goes to P&L. Difference in equity component goes to retained earnings. And the amount of settlement, here it happened on cash basis. So the amount of debt settlement, which is 9729, amount of equity settlement 7 lakh 7280, together 1 crore 5 lakh, both together paid in cash, so 2 cash. Instead, if they are settled in shares basis, then 2 share capital, 2 security premium, whatever may be the balancing fee. So 8% debt will definitely be debited. When debt component will be debited, equity component will be debited. Both are derecognized. 2 cash, since they are settled in cash, it will be 2 shares, 2 security premium if they are settled in shares. But either case, debt revalued amount goes to P&L, equity component revalued amount goes to retained earning. That's one concept, always keep it in mind. Relevant for debt, it's always goes to P&L. Relevant for equity, whether compound or in general, equity component always goes to the balance sheet. I mean, other equity directly, or the reserve surplus, or capital, whatever may be. Only for debt component, it comes in P&L account. Okay, hope no other doubts. Got the complete picture. And the equities are not issued. Here equity is settled in cash basis. That's why we did 2 bank. No question of issuing shares. Any other doubts? Okay, very good.